This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Our guest today has over 4,000 units under management and has deployed over $750 million of capital. And I am looking forward to this conversation. He's been in this business for a number of years now and across numerous states. Even looking at his website, his team has grown and he is operating at a level that I'm striving to get to myself. So, Dave, welcome to the show.
All right. Thank you very much, Whitney. Pleasure to be here today. I've listened to numerous episodes, so I'm excited to talk a little bit and see what we can cover today.
Yeah, let's do it. I want to help the listeners and myself as much as possible and learn from you and because you've definitely got in there and made it happen. And so I'm looking forward to hearing your story. Dave, why real estate? When did real estate begin for you? Let's dive into your getting into commercial real estate as well, specifically.
I mean, a lot of people have read that Rich Dad, Poor Dad Kiyosaki book. And actually, my grandmother was a real estate agent back when I was in high school. And I always loved looking at this stuff. And I was trying to find where am I going to go in life? Right. And real estate was something that always intrigued me. So I bought my first rental property right around my senior year of high school, which was a $20,000 row home that I had saved up from shoveling. I grew up in Pennsylvania, so shoveling snow and mowing lawns. And I was able to buy one of my first rental properties that my grandmother helped me do. And my goal was really to just buy those and try and have some income from it. And eventually it went from passive to active over the years as it continued to grow.
Wow.
And moved down to Atlanta in the middle of that too.
I want to ask you about something there, though. It's so interesting that you're, as a senior in high school, you purchased a rental property. Wow. Congratulations, just making that happen. What was the influence there, though? Was it the grandmother mostly? Were there other influences in the family that was made you want to pursue something? It's not the norm as a junior, senior to be thinking like that, long-term investing. Explain a little bit of that.
I came from a family of entrepreneurs. My dad started a business with his family members and they operated that for almost 40 years that they did it. So I kind of grew up in that mindset of a family, and the real estate part was always something where this is something you could buy and you could go do work on it yourself instead of most high school summer jobs, at least when I grew up, were mowing lawn or caddying or doing something like that. But this is where something I could really go out there and work on it and add value to it and then receive that rental income. And, some of that comes from just the Rich Dad, Poor Dad book of hey, this is a good long-term way to look at things. So I saved up my money to do that. I mean, I got a mortgage on that house when I was 18. So it's it was an interesting journey starting with that. I eventually got up to about 15 of those little single family homes, row homes that I was able to buy. And I just managed those. And that was really when I went through college, that was my income that was coming in the door was from that stuff. So, yeah.
Incredible. So you purchase these, 15 single family homes, you're managing them while you're in college. What an experience or education right there by itself, much less outside of college, while you're doing that at the same time. I love that. Speak to though, okay, 15 single family homes now, yeah, you're in college. Where did the real estate business start to take off? Was that your plan? Was that, what were you in college to do? Or did that change?
When I was starting, that was always my plan, was to get a job, save as much as I could to then go deploy that and buy real estate. It wasn't, and I did that for a number of years before I really even thought about the syndication aspect or even approached the idea of hey, maybe I should bring on investors to do this. And I was in school in Washington, D.C., and I owned stuff in Eastern Pennsylvania. So I was driving back and forth all the time. And it was definitely a challenge for a number of years. And eventually I was there's got to be an easier way to do this. Or at least I should buy stuff that's closer to where I'm physically at instead of doing that. But I did that for a number of years. It would have been nicer to have a mentor that explained, hey, maybe you don't need to go do this crazy distance. In that, I moved to Atlanta around the 2008 timeframe when everything got pretty challenging in the real estate world, 2008, 2009, mainly because there were some great opportunities in Atlanta that I wanted to take advantage of. So, and over the years, I had met some great people. I had two business partners at the time, and moved down to Atlanta to start buying stuff down here. So I could be one closer to it. There were better deals and easier to operate.
So what did your portfolio look like when you made that transition to Atlanta? So you'd already purchased a number of single family homes, had figured out, okay, this is, something I want to pursue. You already had a couple of business partners as well. What did the portfolio look like then before you moved?
Yeah. So I had some of the single family homes. I had some small apartment buildings in Pennsylvania that I couldn't just sell and exit right away. So I was operating those for a few years as I moved to Atlanta. And one of the main things I was always good at, or what I did, was the operator. So the first properties I bought, I did all the renovations myself. There wasn't a team. It was more me just trying to go figure things out and do it. I was lucky that I had some great contacts in Pennsylvania that could help me with, figuring things out. But I did all that work and I brought that down to Atlanta. So I had a little bit up there, and in Atlanta, we really started as an operator. And we grew a basically single family management company out of the gates. That was the fastest way, really, when I was in my late 20s, like, how are we going to make some revenue to keep the lights on to start with? And it was property management that really led the way for that. And that was when a lot of people were struggling to sell homes. So they were like, hey, I can't sell this home. What am I supposed to do with it? And, me and my business partner that I had down here were like, hey, we'll step in and we can operate this and we'll lease the home for you. And we weren't real estate agents. So we're like, look, if you want to sell it in the future, happy to use whatever real estate agent you want to sell it, and we'll lease it for you in the time frame and manage it. And we did that for a lot of couple hundred single family homes in the Atlanta market for really the first 3 or 4 years. And that was our way into the Atlanta market. That's how we built a lot of our contacts, and we were able to then start securing deals that way, because I didn't know a single person when I moved to Atlanta. We had to go build that network and go meet people. And that was a great way to do it. So management really led the way of understanding the market, seeing what's out there, and meeting people in the space.
How did you get established there?
So, the property management was really the key point of getting things going. And then from there, we branched out into some other cities that were around Atlanta. When you look at the South, you look at Georgia, Atlanta is obviously a huge market, but there's a bunch of other cities that go out from there. University of Georgia and Athens, hopefully they do well this year. That going up to Gainesville, you go to Greenville and Charlotte. You kind of work your way all the way up 85, and it's a huge growing corridor. So really going up and down that path endlessly for years on the management side, we were able to start securing deals in that footprint as well.
Wow.
And that's how really, we started buying deals that were really just smaller in size, not like 200 plus apartment units at one time. That's pretty competitive space. Even back then it was competitive. So, but we could pick up 50 unit deals and 80 unit deals here and there with really little competition. And, one of our best kind of kickoff stories is we go to a property we're looking to manage, and it was maybe like 45, 44 townhomes. And we're talking to the woman that owns it. And she's like, we mentioned, we're like, hey, we'd consider just buying this from you. And she's like, you would buy this place? We're like, yeah, we would buy it. She's like, what else would you buy? And she drove us around and she pointed out all these different apartment complexes and stuff that she owned. And we bought the majority of them from her, and we still own some of them to this day. That's 12 years ago now that we first met her. So it was an interesting conversation. You take a lot of these meetings and see where they go. And from that, we got some great deals that we still own today.
Interesting. I want to come back to that investment strategy a little bit. You talked about, you own some now that you purchased 12 years ago, but obviously you all have grown a lot since then as well. I want to back up a little bit for those who are getting started in this space, or maybe even the high schooler that's listening to this. I hope so. And I hope they're motivated by your story. What would you do different if you had to think back to, you being that senior that's looking at that single family home and knowing the path that you've taken? What would you say to that senior today, as far as how you did it, or maybe how you would advise differently?
Real estate is a long game, and it should be a long game. I think you don't want to try and jump in and try and make money instantaneously. A lot of guys, even people that are saying, hey, get a mentor and, put in some free work so you can learn. That's so important if you're going to start out in real estate. Most of the people you meet that are successful in real estate, they're like, oh, I've been doing it for 50 years. You can't fast forward 50 years. You've got to start at some point. And really starting in the operating side, or anything you can do to be hands-on with the property to understand how they work, just enables you to make better investment decisions down the road of like what type of stuff to buy, what type of stuff not to buy. And it helps you with your financial modeling, helps with underwriting, everything. You understand why insurance rates are different when you're buying a building built in the 80s with polybutylene piping that's going to burst all the time when it gets cold. It's like, you don't want to buy that. That's going to be a headache. If you're in there able to see that in your younger years, and you're 18, 20, 22 and kind of get these disaster experiences that you look back on in our great pieces that kind of mold how you make decisions. I think that's important when you're starting out.
So be willing to work for free, right? And you're gaining such an education. Sounds like, by being willing to work for free. Speak to finding that person you'd be willing to work for. I know you had some family members that were entrepreneurs, which is so helpful, I think. But any advice on how you guide people to, hey, find that property management company or that operator that you're willing to go, put some time in with?
When I started, though, the only way to really do that was to literally go and knock on doors. We didn't have like meetup groups. I started in early 2000s. So there was no, or at least that I knew of, there was no meetup groups. There was no like online forums. I think we had AOL Messenger. I don't think that was a good way to do it, but it was really just going to different real estate shops, knocking on the door and seeing who was there that I could talk to. That was how I started doing everything. And you can reach a lot more people now with just anything like this or social media or any way to get out there. So, but the concept is still the same. Still got to reach out to people and be willing to be vulnerable and say like, hey, I want to bring value to you. This is how I can help. This is what I can do. Give me a chance. I think doing that is really the best way to get started. Really anything. We can real estate anything.
What about the transition to Atlanta and now scaling? Some tips there, maybe some challenges that you face that you could help the listener with even through that transition from smaller units, single family, small multis to now being able to do large assets as well.
When I first moved to Atlanta, I had two other business partners that I was good friends with and I had met over the years. And we moved to Atlanta and the group of three of us like, hey, we're going to start buying some bigger apartment buildings now. And look, we're going to have to show up and do all the work. And one of our partners is like, I don't think that's for me. I don't necessarily want to do that. We bought this. It was a 70 unit apartment building that we bought for $900,000. So you can imagine the condition that it was in. And we did a ton of the work on that thing ourselves. So, moving down to Atlanta in that transition, we had to go find all the trades. We had to go find everyone to help with. But that property management experience helped us know what to look for and what to do. But it was really got to start somewhere. So we took that first bet and we did a bunch of the work ourselves across that whole complex and learned a ton from it. And the investment did great. So, but it was a long-term strategy. We weren't trying to flip anything. We purchased it and we were aiming to hold it for a long term.
Speak to your strategy a little bit. I know you mentioned that you own some even today that you purchased 12 years ago. How is your strategy? What was your strategy back then and how has that changed to today?
Back then, my original strategy was to see how many more checks. I thought like if I had more checks coming in than I had going out on a high level, that should be successful. So it's like just get more money coming in the door than you have going out the door. Pretty basic thought process. And from the investment side, it's really knowing what we are good at and what I can do as an operator. So for the most part, buying 1 and 2 story brick garden style projects. And now, those are apartments. Those can also be medical buildings that can have an industrial flex feel to it, the office, but it's all the same type of an asset if you were to look at it. And I can operate that stuff and I understand that stuff and we know what to do when we're in those assets. I think if you're looking at investment decisions and you're trying to pick that stuff, there's a lot of sexy things out there that you're kind of like, oh, should I go do this development project or should I buy this fancier looking asset? And kind of shied away from that and just stuck to what I've known over the years. And that's really been kind of the guiding principles of what we invest in because we got to operate. We operate everything that we own. So if we can't operate it, we're going to run into some challenges. So we don't buy that stuff.
Yeah. Maybe you can help me and the listeners as well with that thought right there. It's like staying focused on what you know versus being willing to say, go dabble in some development or go dabble in some self-storage or mobile home parks or, moving across different asset classes. I mean, some operators I know are in a half a dozen different asset classes, right? And I would say often they're probably not the operator, of all of those, right? But how do you look at that? How do you keep your team so focused and not get the shiny object syndrome, right? That we often talk about.
I think as a leader, I definitely have. I'm not perfect at that. I don't think anyone is, but you've got this kind of like, hey, I want to go do all these other things because they sound great and they're fun, and your team is looking at you like, what is this guy doing? Why? Like, I thought we did this. Why are we going to shift to do this now? So I think it's kind of a discussion you've got to have with yourself of keeping yourself and your firm focused on what you're good at and what your team is good at. And there's always opportunities to just invest in that in the other asset types passively. As you're out kind of in the game, meeting everyone in real estate, find a good self-storage operator or a good hotel operator, it's probably easier to just invest with them than it is for you to say, hey, I'm now going to stand up my own hotel division and I'm going to become an expert in operating hotels, instantaneously. It's like probably not going to happen. They're completely different than apartments, even though it's still real estate. It's still the same. At Greenleaf, we're sticking to just what we know. And that's stopped us from doing a lot of deals. Development over the past probably 7-8 years has been phenomenal in the multifamily space, but we don't build stuff. It's not a skill set that we have. It's not one we've developed. So we buy and we operate efficiently. So we've never built anything.
Yeah, I think there's a lot to be said for being laser focused, right? And being really good at this thing that you do. Whatever it is, like you said, if you're the hotel operator, great. If you're multifamily, great. If you're development, whatever it may be, there's just a lot to be said for being especially your whole team, right? Being focused on this thing and just all the reps, right? And getting better and better and better at that thing. So I can relate to that completely. I know we've debated about some other asset classes, but I think it will be a slow go. And even then, we're going to keep focusing on what we're focused on as well, which has been multifamily.
Yeah.
So, speak to, finding those promising deals. And I know we don't have a ton of time right now to go into your whole deal criteria or finding process, but maybe you can lay out your deal criteria now, since it's probably changed, over the last many years, right? Since you got started. But what's your deal criteria now, for your team, and, walk through a little bit of that process of finding those deals now? Cause I know you're spread out across all the South, number of states in the Southeast.
Yeah. So now, based out of Atlanta, but we are buying deals that are in multiple states, but we really look at that. If you know about Atlanta, 85 is the highway that goes all the way up to Raleigh, Durham up in North Carolina. So we're really sticking to that corridor. And we like that corridor because of the population growth that's there. You look at states in the Southeast, they've had tremendous population growth over the past 5-10 years. So we're really just trying to invest where growth is happening. Again, we're not building, we're not developers. So we will buy stuff that's right next to very large developments where people are pouring, $50, $100 million into projects. That's exciting for us because we get to be part of that growth, but we're taking on way less risk when we make our investments in that stuff. And then also, just basic criteria. We're not trying to do the biggest and fanciest deals. So our typical deal is between $5 and $20 million. We really haven't done any deals. I've done probably 130, 140 deals and only a few deals that have been over $20 million. It's kind of this spot of it's expensive if you're going to do it on your own, $5 to $20 million. Not many people can write a check for that range. But if you're a big institution, you don't really want to buy a $10 million deal. So we're kind of in a middle ground spot there. And there's a good amount of operators that stick to that sweet spot. So that's where we are. And then the other investment side is really making sure we can operate it. It's got to be an asset that is where our team is. It's got to be in our path of growth as a business. And we have to be able to get to it easily and get home from it easily. So we've got to be able to do those three things. And quite frankly, that cuts out a lot of opportunities where, you could go somewhere else or you kind of stretching your team too thin and you're probably not going to see great returns when you do that. So we stick to that part and it's been working. We don't plan to change it for right now. So
yeah, no, it's incredible. Again, I was looking over your website earlier and noticed a number of assets that you all have that are very interesting. I want to jump to that and maybe in the next topic as we dive into some different strategies, that you all have used. Well, let's dive into the key considerations around, investing in multifamily that you all are considering, thinking about right now. What does that look like?
I think we're looking at buying multifamily or any of the deals that we've bought in that space. There's a lot of talk of just, right now there's a shortage in supply and, it makes it sound like multifamily as a whole has so much room to grow, but it's way more focused and localized than that. I mean, Texas and Florida are excellent markets overall for population growth, which is key to having demand. But if you look at apartment deals as a whole, it's not equal in every state. And a lot of things we focused on when buying those is we want to know not the 5-mile radius, but we want to know like the 1 block radius of what are the potential opportunities with this asset. Example of that would be we bought some townhome deals that are directly across the street from an elementary school. It's like, they do move schools, right? But for the most part, this is a heavily populated area. That school's not going anywhere. And it's easy to rent the townhome simply because they are right across the street from the school. Kind of matches up with the age and the demographic of people that have little kids or probably in a more townhome starter home as they're growing. So we look for rental opportunities that fit a very specific case on where it is, not just, hey, this 5 mile area because of a census report looks like it has a good median income. That's not going to do it when we're making investment decisions. We want to see exactly what's happening on what the surrounding area is.
Speak to how you stay connected with those local areas like that, or have that much knowledge. Obviously, you all are buying in, lots of different states and different cities, localities now, or maybe it's the deal that's presented to you. Then you dive into that space. How did your team then find those things that you're talking about?
A lot of it is being out there and driving these areas so you know exactly what things are. And then our relationships and brokerage relationships that we have and team members, they'll look at a deal just like that, like kind of this mid-size residential. It could be any kind of residential, right? Apartments versus townhomes or something even more creative. But they'll be like, wow, this looks like a Greenleaf deal. It's right next to some of these core retail, core shopping, schools. And it's smaller. It's kind of tucked away here. It's not the most prominent thing on the street. It's like, that looks like a deal we would do. So kind of everyone across the board in our company knows what that looks like. And with a footprint of people out there operating, we have individual team members that will come to us and say, hey, I found a deal that looks like this is one we would buy. It's everything else we're operating. And we've been able to secure deals that way too. It's not just one acquisition guy going out there looking for something. We have a whole team of people that are out there keeping their eyes open to see what looks like something we would operate.
Yeah, that it does take a team of people, to say the least, right? What about, just historical data that you all consider or look at to show that, hey, multifamily is the top asset class?
We've always just looked at population growth. If people are going to need a place to live, that sounds like a very basic way of looking at it, but we're trying to be in areas where there's high population growth. And in that way, you don't have to be like necessarily the leader or the absolute best at something. If you have flat population growth, someone's going to come in and build something new. And now you've got to compete with whatever's next and best. But if you have a growing population area and you have an affordable product, there's going to be demand. Now that demand and prices of that's going to go up and down. You've got to be prepared. It just doesn't always just go up forever. But you're at least in an area with population growth. So you've got a kind of influx of people all the time.
Speak to, even pros and cons of multifamily that maybe, whether we're active or passive, that we should be considering that you all keep in mind.
I think one thing right now that when you have to think about with inflation kind of where it is, and I know they're going to try and bring it back under control and they've already pushed rates a good amount to do that. But when you look at multifamily, for the most part, you have rental rates that renew every year. And there's been a lot of news like, hey, rental rates are up 10 or 15 or 20%. Because rates renew every year. Commercial assets, they could be 5 years before you have a renewal. But hotels on the other side, they get to reset their rates every day. I don't think there has been a lot of news about hotel rates have doubled. Well, they can raise the rates every single day. And it's seen as it's not like a stable home that you're there. If you want to go to the hotel or don't want to go to the hotel, they're raising their rates. So I think multifamily, you're kind of in that middle ground of you've got 8-9% of your leases that are probably turning every month, and you can stay up to date with where the trends are with inflation or what rates needs to be in your market. You don't have to do it all at once like hotels, and you don't have to wait 5 years in the commercial space. So I think you're in a good middle ground with multifamily purely on that inflation and that rate increase hedge.
I was noticing on your website, you will have quite a bit of multifamily, but then you also have a few restaurants or maybe a few Dollar Generals, different things like that. Speak to, getting into those asset classes, why you would do that. Is that still part of the focus or the plan? How do you get that, fit that into your all's plan?
I mean, we fit it in patiently, right? So a lot of times if I'm driving around and you see like, hey, this looks neat, this looks neat, this looks neat. And your team's like, wait a minute here. Like I thought, we'd staying focused. But on the other side of that, a lot of the deals we've bought outside of multifamily started because they were right down the street from a multifamily deal we had. So it was kind of a natural progression of, one multifamily deal we had on a street here in Atlanta, a restaurant, when we don't operate the restaurant or we don't own the restaurant business, but the piece of real estate came up and it was right down the street from an apartment deal that we owned. And we're on this road all the time. So we know the area, we know that it's a good property, and it was vacant at the time. So we purchased that, what is now a restaurant, because it was right next to, we were already there the whole time. So a little bit riskier. It's not, it wasn't something that we were necessarily had a distinct skill set in, but we did know the area very well. We knew we were getting it at a great deal, and we were able to lease that. And now there's an operator in there. They operate the restaurant. They're doing very well. But that's kind of the commercial asset that we were able to get right down the street from one of our apartment buildings. So we have a lot of now commercial assets that are really just, they're down the street from apartments that we had, and they look pretty similar. So it was something that we could operate, and we knew about them just because we were in that specific area. It wasn't 200 miles away in a different city.
So you all are managing anything that's outside of multifamily, you all are managing as well.
Correct. Yeah. So we have two teams now. We have a commercial team and a residential team, and they work together. We have the same kind of support team around that for accounting and insurance and CapEx work, but mainly because we are buying 1 and 2 story brick buildings. They're all pretty similar. They're in the same locations. So we can operate those collectively with the team that we have.
Yeah, that's awesome. Well, yeah, I just wanted to highlight that to the listeners. I know we'd talked about staying so focused, but I love that you all said, you know what, we're already in this area. We know this area well. Here's an opportunity, and you all went after it, after these opportunities that were close by other assets that you already had. And so, well, Dave, is there anything else, around our discussion today you want to mention and before we close out this segment?
No, I think when you're looking at just other opportunities that are out there, I think you just got to stay focused on the area that you're in. To me, it's like, as long as you can operate and see how something is working, you can get more comfortable with that investment decision, whether you're the general partner in it or if you're one of the limited partners coming in. And we frequently have limited partners that are local, and this is their passive investment. It's not passive for me and my company. We're very much active in it, but they want to be able to come and see their investment dollars at work. They want to come and see how things are happening. So I would encourage people to invite your investors out to the deal, show them what you're doing. We think about, our strategy with our business is really like a triangle of relationships. So we have our investors on one side, we have our tenants and residents, and then we have our team. And the more things we can do that really bring those 3 pieces together on a piece of real estate, the more comfortable everyone can be with it, and really just the more transparent it is. I think that's what probably everyone wants in life, is transparency. Whether you're a resident, whether you're a tenant, whether you're an investor, you want to know how things are being done, how are those decisions being made, and as transparent as you can be with anyone, I think that'll just make that relationship better and ultimately make your investment perform better as well.
Communication is key, right? Yeah, almost in any relationship, it's so important. And that transparency, man, about what's happening. Yeah, it doesn't matter if it's tenants or investors, like you said. Yeah, Dave, you're doing a lot in opportunity zones, and it's something that I have not heard as much on the show about lately. I know a year or so ago, or maybe a little longer, it seems like we were talking about them a lot. But it's interesting to dive back in. And so why don't you give us a highlight, though? What is opportunity zone? Like, what a qualified opportunity zone? What is that for the listeners that have never heard this before, and maybe why they should know what this is?
Right. Yeah. I mean, opportunity zones came out really in 2019, and there was a lot of information, and then kind of the pandemic hit, and it's kind of slowed down the conversation about, are these good opportunities? What is the opportunity zone? Should we be there? A lot of that kind of I think it fizzled out a little bit, but we touched base too about just being in the game and being in real estate. And that's where you kind of identify opportunities. We found out about these in 2019. We're purchasing some big value add multifamily deals, and the opportunity zone legislation came out where it was like, hey, if you just buy these with purely capital gains from anything, they could be stock sales, other real estate sales, any capital gains you have, you could defer all those capital gains and invest them into an asset that's in this opportunity zone as long as you improve it. We were already going to do that anyways. We already had these deals teed up to do. They were big value add multifamily deals. So perfect. We'll just use capital gain dollars outside of a 1031. I think a lot of people are familiar with a 1031 exchange. You didn't have to do the 1031. You could purely sell your asset, take those capital gains, and purchase a real estate asset with it and defer all your taxes. So there was a good deferral mechanism in there, but those taxes do come due in 2026. No matter how that real estate deal performs that you purchased in 2019, those taxes still come due in 2026.
Yeah, I wanted to point out there, you mentioned defer the taxes. It didn't mean you don't have to pay them, right?
Correct. Yeah. The government didn't just say, oh, you don't have to pay anything anymore. It's like they just deferred them until 2026. So government looking at that, and it's at whatever, the rate was, the capital gains rate at the time. It's a little bit dependent on your personal tax bracket, but you've got a chunk between 15 and 23% of tax liability that was deferred to 2026, that in 2026, no matter what happens with that real estate deal, you're going to have to make that tax payment on it. So our whole strategy was to buy value add deals and be able to refinance them at some point between now and 2026 to provide some cash out mechanism, well, through the refinance or through just earning money on the deal, so that investors can use that to pay their tax liability that is coming up. So I don't know if that's going to work out on all deals that were done in the opportunity zone, though, across the board. So I think there's definitely some opportunities outside of the original thesis of buy and hold long term, where people are going to have to make tax payments coming up in 2026. And how close do they want to get to 2026 before they know if they have that cash or not?
Yeah. I've not heard many people talk about this. If anybody, now that I'm thinking about it, about that being an opportunity, right? 26 is coming up. Man, like you said, they're going to have to sell over the next couple of years or do something to generate the cash to pay the taxes, right? And so, man, maybe that's an opportunity for buying, right?
Right. And it might not be that someone might have done an opportunity zone deal and it's performing well, but they have this tax liability, so they have to sell something else. So right now we see that with people having to place 1031 money, where they said, hey, I had this big gain. I've got a 1031 chunk sitting here. I need to go. Well, potentially the opposite coming up is, one thing when you're looking at, if you're just in the real estate space, you're trying to identify what could happen out there and where there are going to be some headwinds. That's probably one of them that'll come up, is they're going to have to be some tax payments coming up in the 25, 26 years that people should try and get ahead of and make sure they're ready for it. So even though that's probably after the current mindset of like, what are we going to do if there's a recession, like in the immediate 3 to 6 month time frame? But that's two things right after one another that are probably going to create buying opportunities.
Yeah, for sure. Well, I wanted us to back up just a little bit, though, about just opportunity zones in general. And maybe you could elaborate on some of the risks, involved in doing maybe an opportunity zone fund that we haven't talked about, but then maybe also why you would as well. Maybe other potential opportunities that we haven't talked about that would encourage you to do an opportunity zone fund. So risk, reward, help us walk through some of that a little bit.
If you think about multifamily, was really set up perfectly for the opportunity zone legislation, where it's saying if you purchase an asset and whatever you bought it for, you had to double your investment in that to qualify for the tax deferral. That lends itself very well to multifamily assets where you're buying an older vintage and you're going in and doing unit upgrades and you're doing some exterior work. And it's relatively easy to double your basis in a multifamily asset just with the renovations that can be done. A lot of that is a good opportunity, but I mean, there's risk with any renovation project that you do. So sometimes if you're looking at, hey, I'm going to make this investment, you want to make sure you're doing it because it's a good actual investment, not just because it's going to defer some taxes. There's no point in taking on outsized risk to defer taxes in something that's not going to work. So opportunity zones, I mean, they're all over the US. Every city, for the most part, has some somewhere. And it's a good thing to look at even now when you're buying any deal. If you're going to do capital improvements, like, is it in one of these opportunity zones? It's a pretty easy way to ensure that you can defer some taxes that are going into it through 2026. But overall, sometimes there's a deal that's pitched like, hey, this is an opportunity zone deal, and therefore that just makes it good. That's not the case. You still got to underwrite and make sure the deal is in your skill set, in your wheelhouse of what you know how to execute on. Or if you're the passive side, you're an LP investor, make sure that you're underwriting a deal and looking at it, that it makes sense from a deal standpoint, not just from the tax standpoint.
Any changes since 2019 that we haven't talked about that maybe the listeners should be aware of?
Since 2019, they first rolled out the maps. They redid some of the maps a little bit, where they added areas and contracted areas. So if you would zoom into very specific citywide information, like sometimes this block was in, this block got moved out of it. It's almost like redistricting kind of, but like some areas moved a little bit on the maps, which is important to look at. So there might have been some that were created that were new in the 2020, 2021 that you can go take advantage of right now as well. We've done that in Atlanta where we looked at areas that kind of got added when they did the revision of the maps, and we were able to buy deals based on that. It was helpful.
What about, your vision for 2026 and your projects, your fund? What does that look like? How are you preparing for 2026?
So the tax standpoint, where when we did our deals, we did 6 deals that were in this format, speaking with our investors, knowing that, hey, by 2025, we have to make essentially at least a 20% distribution of capital. And we plan to do that through refinancing between sometime now and then. And I mentioned on some of our other stuff too, like we're doing mostly lower leveraged debt, and we are doing principal payments on all of our debt as well. So the math works on our standpoint when we're just holding that asset through 2026, that we'll be able to pay down enough principal that we could then pull that money back out through a refinance and distribute that to our LPs so that they can make those tax payments. So we've mapped out the investment strategy of that deal to coincide with the tax planning of it. So really have a deal where we have a 3-4 year cash flow plan, and then we plan to hold them past that. So you're looking at a deal cycle that's for the most part 10 years. And for a lot of times that's hard to kind of wrap your head around and say, we're going to make a 10-year commitment to this one piece of real estate or this fund. But we made sure going into that, all of our investors were aligned with that decision process. So with that alignment and that transparency, we've been able to have a pretty good cash flow plan to manage that over the next 10 years.
Any fear from, say, the team or investors that, hey, recession's coming, debt's so expensive, are we going to be able to refi like we planned so they can get their capital, pay their taxes? How do you think through that?
Yeah, certainly. We had one of our opportunity zone deals that we had a loan that was set to expire in 2023. And we started on this in early 2022. And that's kind of rates were starting to hear like, hey, these are going to start going up. And then it took us almost 7 months to fully get that refinance done because we were in the middle of doing the renovation work. So you can't get a great stabilized loan on a renovation project. You've got to actually finish and rent everything out. So we were able to do that. It kind of came down to the wire. And ultimately, in the end, we only have 50% leverage on that deal. We're not able to get any cash out now. But by not having too much leverage, we were able to ensure we did have debt. And then by the time 2025 comes around, we'll have paid off enough that we can distribute greater than 20% of the equity so they can make their tax payments. So it only was able to work. If we had too much leverage, that would not have worked as smoothly as it did going back to investors and saying, hey, we can only refinance with the 50%. If we had 70%, 80% construction debt going into that, we would have been in a pickle, to say the least.
I mean, we've talked about a lot, and I know the listeners have learned a lot. Tell them again how they can get in touch with you and learn more about you.
Yeah, my contact information, it's on greenleafmanagement.com. My whole team is there. And then you can also find me on LinkedIn at Dave Codrea.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.